Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Tuesday, January 10th, and then we'll see how things look for Wednesday, January 11th. And for those of you that watched yesterday's video, the audio quality was not quite as good. I forgot to double check the microphone settings before I started recording, and well, I checked them today, so hopefully this sounds a little bit better. Also, near the end of the video, there's a new section that I'm starting to include in the daily videos that I'm doing more on an experimental basis. So hang tight for that and see if you find that useful. Well, on Wednesday, we had an up day. Things are starting to shift a little bit more positive. Our charts are starting to show some improvement. They're still negative overall, and we could lose this with a fairly significant down day. We're getting to the point where in the short term, we're a little bit overbought, or at least getting to extreme positive territory, but things nonetheless are still showing some improvement. So let's go back and talk about what happened. Right at the open, we had a flat open and prices just chopped around. There wasn't a lot of conviction right after the open, but we were able to climb up to the daily pivot at 39.11. Right before that, we were just hanging out at that 3,900 level. That's kind of it's becoming more of a critical area right now. But after we hit the daily pivot, we retreated, and then we actually went negative for a little while. That's kind of a loosely defined way of filling the gap. There really wasn't a gap to fill, but a lot of times when we have a positive open, after that gets done, then we'll see a move in the opposite direction that'll last for a while. And then after that is when the market determines what it wants to do. Well, in Tuesday's session, prices then chopped sideways, but had more of an upward bias behind them. We were able to climb back up to the daily pivot. We actually closed above the daily pivot and at the high for the day. So that's fairly positive overall, but it wasn't a real big move. But it has helped, as I said, some of our charts to improve. We were up 0.70% on the day, and volume dropped to below average. So that's a little bit of a concern. The last few days, we've seen above average volume. Well, in Tuesday's session, that was below average on an up day. Our technicals, as I said, they're negative still, and they could go back to being negative with the kind of an intense decline, but they are showing some improvement. But we're not coming off of any kind of critical mass type situation. We didn't see a real washout. We were just chopping sideways, and we're getting more to the point where we're developing an upper end of the trading range that we've been in. And as we've been going up, that's helping our technical picture. Inflation and interest rates are producing a lot of growth concerns. That's the real fixation. It might be a little bit calm in Wednesday's session because we're not getting a lot of economic reports. The big day is going to be on Thursday when we get the CPI. So but you never know. Anything can always happen. But typically before a big economic report, it's not surprising to see the market really calm down a bit because it's really a roll of the dice as to what's going to happen. And so people don't want to take really big positions prior to that. Another thing that I've added to this list here is the EPS and valuation concerns that had been on my market comment section. Well, that's an ongoing thing now that we're dealing with all the time. So that's why I'm including it in this section as well. And then we had some Fed speak on Tuesday, but it really, even though it was Chairperson Powell, it really didn't have all that much of an impact. So here is the intraday chart. You see we had kind of a flat open, a little bit higher, a little bit lower. We made it up to the daily pivot. Then right after that, we came down, went negative briefly, and then spent a lot of the early part of the session a little bit positive and bouncing around. Well, as the day went on, prices were able to go back up to the daily pivot, fell down a little bit, and danced right along the daily pivot, but then had a nice little up thrust going into the close. So here's some comments. Fed Chair Powell's speech, it really had limited impact on the market. We were all watching it. We're all paying attention to what he was saying, but it wasn't necessarily anything new and didn't really drive the market one way or the other. The S&P did regain its 50-period moving average, which is at about the 39.07 level. So that's positive. That's one of the more intermediate term moving averages that I use. And whenever we're above that, that's showing that things are improving. Of course, when we're below that, that's more negative. Now we have to start to battle the 200-day moving average if the market is ready to do that. The markets are really anticipating the CPI release that'll be coming out in Thursday's session. Small caps continue to outperform. It's not real blatant right now, but they've had a good couple of days, and that could be more of a positive backdrop for the market. The VIX is still acting strange. It's starting to come down off that spike, and I'll show you that, but we're just keeping an eye on that for right now. The dollar was up. It got down into the 102s. Now, last time I checked, was into the 103s, and interest rates were up. So this is kind of interesting where we typically these two things together with interest rates and the dollar going up, that would put pressure on stocks, but it didn't happen that way on Tuesday. On a short-term basis, our stochastic chart showing some extreme positive readings, as is the Stoch RSI, and I've just added the Williams %R to the list as well. We're still extreme positive with the CCI 14, but that's the only short to intermediate term indicator that we're seeing right now that's giving us any kind of indication. The 30 to the 5-year, it's still back in a more normal stance. It's no longer inverted. So this is the second day now that we've seen that. Well, technically not. In Monday's session, they were even with each other. Well, now the 30-year is a little bit higher than the 5-year as far as its return. But we'll just, again, want to keep an eye on that. But that's not a real biggie in this whole picture. It's the 10-year to the 2-year and the 10-year to the 3-month that most tend to really focus on. Sentiment is still neutral. We're not really getting overly positive or overly negative currently. The economic reports that came out, we had the NFS, and I have a number of charts to go with this, the NFIB, Small Business Optimism. It came in down at 89.8, where the last time it was at 91.9. Edward Yardeni really focuses on this particular economic report, so I have some charts that he posted about that. Wholesale inventories were up 1%, where the last time we got this, it was up 0.6%. This could be a little bit negative. This means that things are staying on the shelves. They're not flying out into the stores to be sold at the retail level. They're sitting in wholesale warehouses, basically. It just means they're getting more of a stockpile right now. But then on the other hand, you could say, well, that's pretty positive because of the supply chain issues we've had. Just to have something available to send out to these stores could be potentially positive. Our trend is still positive, but it's weakening. It just keeps going down, and it just continues to be below that moving average. And overall, the ADX is still below 20. I've had our bias more with a positive slant, but still mixed. There's just not a lot of conviction happening right now, and I've kept our momentum at mixed. We'll have to see the market really, especially after Monday's advance and then giving a lot of that back. And then on Tuesday, we just kind of didn't really do too much. So and then we saw volume really decrease as well. This is a chart that I have been showing now for quite some time. I keep looking for an updated version of this, but don't find it. This is earnings, and the earnings per share, that's the white line, and it continues to decline. The profit margin, that's this orange or gold or brown or rust, whatever color you want to come up with here. It's also declining as well, and sales are also continuing to decline. And this ultimately feeds over into the earnings that a company makes. And when this is declining, that justifies lower stock prices. Then this is another one that I've been showing, are the assets of the central banks. I'll probably stop showing this now because this is a much, much longer term chart. So I'll take it off after today's video. This takes the European Central Bank, the Bank of Japan, and the Fed, and together, and this blue line are the assets that they have on their balance sheet. Well, as they said they were going to do in 2022, they're starting to decrease those assets, and that's been putting pressure on stocks. Then I don't have an updated chart of this one, but I have another one that is kind of interesting, that kind of showing the same thing. This yellow line here, this is what happened from 2006 to 2008, and we've been following that with the white line fairly closely, which could indicate we might see some more weakness.
Now, on Twitter, the same gentleman posted another chart looking at a different time frame. This goes back from it starts over here in 1998, and this is the whole .com run up, and then all of the problems going down into 2001 when we hit into that bear market, and then 9/11 happened and everything just went crazy for a while. The person who posts this at Mott Capital, it's Michael, I don't remember his last name. He's seeing a pretty strong correlation here. And again, it's kind of saying the same thing that the other chart is, that we could see some weakness going forward from here. So both of these charts, if we stick with the same basic price pattern, are suggesting weakness in going forward. This is the Edward Yardeni chart. This just shows the NFIB. I don't know why I have trouble saying that. The small business survey and the JOLTS job opening. The small business survey came out recently, and right before that, before the employment situation report, was the JOLTS job openings. And my understanding is the Fed really pays attention to that. And the blue line are the JOLTS. So it just shows that even though we have a lot of jobs available out there, they're starting to decline. And the small business with job openings, that is also starting to decline. And most people work for small businesses. And that's kind of the real backbone of the US economy. Not everybody works for a really big company. So this is something that we pay attention to. And when we're seeing this decline, this is kind of feeding into the idea that maybe the employment situation might be weakening a bit. Here's another one. This is the survey that they took. These are job openings and the plans that they have to hire. The green line here is with few or no qualified applicants for job openings, and that's been decreasing. The blue line is those that have job openings, and it's been going up, but now has been coming down. And those that plan on increasing their hiring over the next 13 months, that's also, over the next 3 months, that also has really been declining. So we're seeing some weakness starting to come in to the employment situation. Here's another one. The small business survey, their pricing, where they're planning to raise their average selling prices. That's coming down. That's the red line. And those that plan on raising their selling prices, that is also coming down as well. Those that already have and those that plan to. Then that could help a little bit more with the inflation situation, with prices coming down. These are the inflation expectations. This is looking out 1 year and 3 years ahead. They're seeing that both of these just show that there's an anticipation of a decrease in inflation. So I get his emails every day, and they're freely available. It's called Quick Takes, I think. And sometimes I look through this and it doesn't really help us to determine much. Plus, he was ill, and then you had the Christmas holiday, so I wasn't really getting a lot from him in December. Well, he seems to be kicking back into gear. And videos that he posts on YouTube can also be very beneficial if you're into that kind of thing. Can be a little bit dry because it's economics, for heaven's sake. Here is the ratio or the correlation between the VIX and the S&P, where it did really spike up at kind of a high level, and it's continuing to come down. Now we're going to keep an eye on this to see, is that going to produce a change in trend in the S&P? A large part of the time when we see these red lines after a spike, that produced weakness in the S&P, but there were also a few times where it produced some strength. It just means that there potentially could be a change in trend, but we're not really in a trend right now. So we don't know if this is going to end up being a positive thing or a negative thing. The Ulcer Index is still it's below the average of the red line here and drifting more into positive territory when we're below this red line, where our other sentiment indicators are more neutral right now. Here's the equity put call ratio, another thing that we're watching closely because the VIX is really just not doing much right now. Ticked up a little bit on the daily chart. And then this is where we really pay attention, is the 5-day simple moving average. After really spiking up, that is coming down. But I've been trying to warn here that we've been going sideways when this happened. We didn't see a real spike down in price or any kind of capitulation. Then this is just a longer term look at this chart, and we finally came down below this red line. So we're no longer really extreme, and we can, for now anyway, call this a decline overall. So we want to keep an eye on this. Our trend just continues to go flat to slightly down with the ADX below the moving average. So there's no trend happening right now, but we will default to the positive side because the green line's on top, even though it declined, but the ADX is still below 20. The vortex also recently crossed over positive and is still holding up. Here's the short-term chart of the Stochc RSI. We're still in extreme positive territory, but it can camp up here for a long time. So just something to be aware of. The same thing is true with the Williams %R. It's not quite as extreme yet, but it's going back into extreme positive territory. And then the CCI has been camped up here for a couple of days, the 14 period, where the 20 period is still more neutral. So we're starting to see a few of these short-term indicators camp up in the positive side of things. Here's our oscillators, and I bring this up even though I modified this chart. The top two are more shorter term. They're turning positive. They've already turned positive, where you have the intermediate term MACD, PMO, and PPO. They're starting to cross back over positive. Our longer term ones are showing improvement. The KST might cross here pretty soon, but they haven't crossed yet. So this is showing a lot of improvement overall. Here's our PMO. It's just about getting ready to cross above the moving average, and we did get a lead both based on price and volume where these crossed beforehand. Bullish % index, it's still above 50, not really moving up all that much as we're seeing prices advance, but this is looking more positive now that we're above 50 and we've been staying above 50. The stochastics in the short term starting to get extreme positive, just coming into extreme positive territory with the intermediate term and showing some improvement after being extreme negative with the longer term stochastic. Our daily chart, we're still above the pivot point. So as we're still above this pivot point, that's more of a positive slant. If we drop down below that, that is more negative, where recently we've just been camping along this level. And you can see the blue line here, that's the 50 period moving average. And we were able to get back above that and close above it. On the bottom, you see where volume really dropped off. Balance of power, it's gone above this dashed line, so now that's more positive as well. When we're above this area, that means it's positive. When we're down below it, that means it's negative. Swelling trading oscillator based on price and volume still continue to show improvement and are not extreme at this point. And here we're coming back up into the moving averages, and we got back above the 50 period moving average. Can we stay above that? The big one is going to be the 200-day moving averages. See how we bumped into these a number of times, and that ended up being a reversal for the markets. Even though we broke above them here, it didn't last very long back in December. The summation index based on price and volume also continue to show improvement. New highs, new lows also showing improvement with the 5-day and the 10-day. And the short-term fib level, we're getting just a little bit above this red 50% retracement. Can we stay above that? I don't have the longer-term fib chart because we're right in the middle now. We've been able to get back above some pretty significant levels. The Copic curve is also giving us what could be a buy signal. The lines have crossed, and we're going to see, can we break up more out of this? And the Pring bottom fisher also starting to cross over. I showed this yesterday where it hadn't quite crossed. Well, now it has. So now we're seeing a confirmation of potential buy signals here. And the staples to S&P 500, this is continuing to drop. So this might be a valid point to work from. And other times when we spiked and started coming down, that often marked a low in the S&P 500. The mid caps are still holding up above their pivot after giving a recent golden cross, and the Dow the same way, also above the pivot and working off of a golden cross. So what's our outlook then for Wednesday? The technicals, they're still negative. We still have a lot of negative backdrop going on here, but they're turning positive and they're showing some improvement. But we have to see follow through price action, especially going into the close. Can we close higher? It may not be decided all that much in Wednesday's session if things remain really quiet. Thursday could be a pretty significant day. We have the weekly MBA mortgage applications index coming out, and that's it. So there's not a lot of economic news to drive the markets. Then the whole list where I've added the EPS, earnings per share, and valuation concerns to this overall geopolitical event, because this not only applies to US companies, it feeds over into companies around the world as well. This is the new part. And I just was looking through what's called the Stock Traders Almanac, and every year they come out with a new version of this, and it's for 2023. And I look at this all the time and I kind of use it in the background, but I'm trying to present it now to you to see if you find this more useful. Some of this page will change every day because there are statistics for every day. But on the top part, and I'm sorry that it's kind of small, I hope it's not too hard to read, but there are yearly statistics that we look at, there are quarterly, there are monthly, and then there are daily. Well, one of the things that we're picking up is we're trying to determine now, there's a thing called the January barometer. If we close up at the end of January, ever since 1950, after that, the market follows it 83.3% of the time. So if we have an up January, we have an 83.3% chance of having an up year. Okay, that also means that we have 16, 17% of the time when we don't have an up year. So these are just probabilities that we'll be looking at. Then we have a thing called the January trifecta. And right now it has a 2-0 score. There are three things. That's trifecta. The Santa Claus rally was one of them, and that ended positive, even though it hardly felt that way. But from the time they start the Santa Claus rally until it ends, we were up. So that's a score of 1. And then the first 5 trading days of the year, well, that ended up being up. So that gives us a score of 2. We won't get the third score until the end of January. But right now, it's having a 2-0 score as far as this indicator is determined, or is concerned. Then when all 3 of these indicators were positive, the next 11 months, so February through December, they've been up 87.1% of the time, and their average gain has been 12.3%. And then the full year was positive if you take all 12 months, 28 out of 31 times, which is over 90%, with an average return of 17.5% in all the years that they've measured. And this goes back decades, 1930s, some of these even 1950s, even some of these go back before that. Then the markets also like having a mixed government, meaning that we have a Democratic president, we have Congress, which is also split. The big fear of the markets is the Congress is going to get in there and start screwing around with things and make it a lot more complicated and more difficult. That's less likely to happen when you have a mixed government. So the Dow, I couldn't find a figure for the S&P. It might be in there just buried somewhere. But the Dow has average gains of 16.4% since 1949, when we don't have one party or the other completely controlling the government. So right now we have in the presidency, there's a Democrat, the House is Republican, and the Senate is Democrat. Then looking at some quarter ideas, and this top part of this chart won't change every day, so I'll probably go through it a lot quicker as we continue to go through this. When looking at November, December, and January, this tends to be the best 3-month span out of the whole year. And so we're coming more into the end of that. Again, try to realize that for the folks that had really difficult times in 2022, they're going to need January to be really good to kind of save what they really suffered through in November and December. Then on a month-over-month basis, looking back over the last 23 years, we've had advancing days 10 out of 23 for 43.48%, but we've had more declining days, 13 out of 23 at 56.52. Yes, if you add that together, that does equal 100%. So there's more of a negative look or more of a negative slant on a month basis looking back to the year 2000. Then from January 2001 to December 2021, this is what we're looking at on the day in and day out basis, and this is what will change more often. Well, this will change every day. The Dow is on January 11th, this trading day, is up 57.1% of the time going back to 2001. When these folks really get excited is when it's above 60. So that's more neutral to positive. However, the S&P has been up 66.7% of the time. So that January 11th, 2023 has a 66.7% chance of being an up day. And then with the NASDAQ, it's even greater at 71.4%. So let me know what you think of that, if you understand it, if I should present it in a little different way. It's a book that I would highly recommend. It's not cheap. It's going to be one of the more expensive books that you get. I have the Kindle version of it, but you can subscribe to their website and you get a free book, but it's not a cheap subscription. It's over $40 for the book. So you'll have to weigh to see if you think that that is something useful to you. All right. So what are the scenarios then for Wednesday? Can't really go with the down scenario because our technicals, even though they're negative, we're starting to turn more positive. Plus, we're not trending right now. Can't really go full-blown positive yet, even though things are looking better. Our scenarios, our rotation, our setups improving a little bit, but not anything really significant. The technicals, yeah, they're looking better. We regained the 50-period moving average. We're staying above pivot levels. We're regaining some fib retracement levels. So that's more positive, but we're not trending now. So that's still what we're going with. Even though the ADX is weakening, it's still below 20, but the green line's on top, so it is positive. Our conclusion, not really a lot has changed. The S&P is negative, but improving. We have to see some follow through here. In the short term, it's still negative, but starting to become more positive and even becoming short-term overbought. Intermediate term, negative, but showing some improvement. Long term, we're still negative overall as long as we stay below the 200-day simple moving average. Thank you. I hope some of the additions to this video you find helpful. If you get a chance, I did post a video over the weekend that shows all the charts that I don't cover in the videos, and that'll change every week. And so I'm looking at doing more shorter term daily videos and then breaking out and showing you the things that I don't show in some of the weekend videos. So have a great day, and I'll talk to you in the next video.